So where we had left off on Monday, open up that PowerPoint file, is we were talking about multiples and multiple analysis. 7. And I said there were 6 multiples that we needed to track this semester. So part of what we're going to do in multiple analysis is we're going to get the data on these 6 multiples, right? And I'm going to show you how to create a template in Bloomberg to go get this data, right? So we've been talking about Coca-Cola, so we're going to continue to use Coke as our in-class example. And then what you're going to do is I'm going to give you a different series of companies, and you're going to do this analysis as a homework assignment for Monday, including the write-up. Okay? So kind of we'll go through the process in class, but this is the process that you're going to need to do for the next homework assignment. So let's start out with the multiple data that you need to get. So as I said, there are 6 multiples that we care about. Price to earnings, PEG, enterprise value to sales, enterprise value to EBITDA, enterprise value to EBIT, price to book. If you go back to Monday, we talked about 4 of these ratios, right, relative to the key value drivers. Right, we talked about how using the key value driver formula, we can create a price to earnings ratio, right, by switching out equity versus the sort of debt and equity invested capital. So NOPLAT became net income. Return on invested capital became return on equity. Weighted average cost of capital became cost of equity. Growth became growth in equity. But the point is that we could basically look at the drivers of the price to earnings ratio, right? And again, the one challenge with price to earnings ratios is that basically what tends to affect that more than the enterprise value ratios are things like capital structure and non-operating items, right? Because those are things that are going to affect net income, which tend not to affect operating income. So even though PEs and enterprise value to EBIT and EBITDA technically should tell you the same thing, the PE can more likely be distorted. So we're going to favor the enterprise value ratios, but we're still going to look at the PE multiple. Second, we talked about enterprise value to sales and enterprise value to EBIT. And again, using the key value driver formula, we rearranged it to give us a formula to calculate an enterprise value to EBIT multiple. Okay? So, and again, these were the drivers of that. And we basically said to get to enterprise value to sales, you take your enterprise value to EBIT and you multiply it by the profit margin of the business. Right? So really, what an enterprise value to sales multiple is a representation or proxy of is a company's profitability. That's going to affect EV to sales more than anything else. Because basically if you have a higher margin, you're going to get that margin times your EV to EBIT ratio, which is going to give you a higher enterprise value to sales. Lower margin tended to be lower EV to sales. So assuming companies have similar EV to EBITs, the enterprise value to sales ratio is going to tell you a lot about the profitability of the firm. Okay? So the other ratio is enterprise value to EBITDA, and enterprise value to EBIT and EBITDA are very similar. Okay? Now, the final 2 ratios were price to book and the PEG. Now, when we talked about price to book, what we said was price to book, in theory, is a way of representing spread. That a price to book of 1 is a 0 economic profit, which is another way of saying over the long term, you're going to have a 0 spread. That's in theory what the price to book ratio is telling you. And in theory, a higher price to book ratio above 1 means you're creating value, therefore have a positive spread. And if you grow that positive spread, then that gets you the much higher price to book multiples. Whereas the price to book multiple below 1 tends to tell you that you are destroying value. So therefore have a negative spread. Now, here's the one problem with price to book. price to book ratios is the most susceptible to being distorted because of accounting adjustments, right? And I'll give you an example of this. The real problem with price to book is price per share divided by book value is book value per share. Or a price could be market cap of the company, market value of equity, price per share times shares outstanding. Book is the book value of the equity. Okay? So it's basically what's the book value of the equity against the market value of the equity. Here's the problem. AOCI adjustments. When accountants make adjustments to the equity, write-offs, then that can distort the price to book multiple and not give you a true view of the price to book multiple. So the good news about price to book multiple is it's one of the cleanest multiples that gives you insight to spread. The bad news about price to book multiple is that accountants often will adjust the equity of the firm, and then you can get some crazy results looking at the price to book multiple. So practical example. This section is not doing defense and aerospace, is it? You're doing railroads, right? Well, the last section, so people watching this video, one of the sections watching the video is doing defense and aerospace. So this will affect them. But if I look at defense and aerospace firms, and very quickly, if I look at their price to book multiples, the biggest defense and aerospace company out there are basically Lockheed Martin and Boeing. Sorry, I'm at IBM. I'm going to switch this to Lockheed Martin. Okay. So here's price to book multiple, Lockheed Martin, 12.8. Okay. Look at the rest of the industry. L3 is 1.69, Raytheon 2.64, BE Aerospace 2.68, ITT 3 something, Boeing 6, Lockheed almost 13. All right? How do you get a price to book of 13 times original value for a company that's not growing that fast? And the answer goes back to 2008. Lockheed, which has a huge amount of pension, right? Because they're a very old company. They go back to the 40s, and they have historically given a big pension plan. So part of the way you do your pension is I say I will owe the employee a pension liability, but then I also take the employee's money that I've set aside and I put it into the pension assets. So when you run a pension plan, you basically invest the assets on behalf of the employee, and then you use that investment income that comes from that to pay off the pension liability. Well, here was the problem. When the stock market crashed in 2008, 2009, and went down by like 40%, the value of their pension assets went down by 40%. So what they had to do is the accountants made them take a big write-off against their earnings for the drop of their pension assets, non-operating write-down. Okay, so it had nothing to do with what they were getting on their programs that they were selling to the government. It had everything to do with the fact that their pension portfolio lost a lot of value because the market crashed. So they had to take a big charge against equity to represent the drop in the asset value. Well, here's the thing. When the stock market has subsequently recovered and the stock market has gone up, they don't get to write up the value of the pension assets to a market value, and they can't take a big gain on the value of their pension assets. So the challenge with the defense and aerospace stocks, and this is what you see in Boeing and Lockheed Martin, is the price to book is distorted because what happened was the drop in the general market wiped out a bunch of equity, and now that the market has recovered, they can't add back the equity. Because that's the difference between the way the accountants treat banks and non-banks. Because banks do mark-to-market. Banks can mark-to-market, which means they can show gains and losses on their portfolios. Companies cannot do mark-to-market. So therefore, they can't show the gain. They can only show the loss. That's one of the problems with price to book, is that price to book is theoretically clean, but unfortunately, it is often dirty. Right? And so you got to be careful when you look at the price to book ratio, because if companies have had lots of one-time adjustments, it can really distort the ratio and give you the wrong answer. So the other ratio that helps us understand spread is our sixth ratio, which is called the PEG ratio, right? PEG is the price to earnings ratio, which again can be somewhat distorted, but divided by the growth in earnings per share, specifically the 5-year expected growth in earnings per share. So here's the way to think about the PEG ratio. What the PEG ratio says, and you can see here, a PEG ratio for Lockheed Martin right now is almost 1.92. PEG ratio says for $1 of earnings growth, how much am I willing to pay for $1 of earnings growth? All right? Where the price to book says for $1 of equity, what am I willing to pay for the equity? So PEG says, what am I willing to pay for the growth in the equity? Well, Lockheed Martin, for $1 of earnings growth, I'm willing to pay $1.92. If you look at BE Aerospace, $1 of earnings growth, I'm only willing to pay 71 cents. Why would I pay more for the growth of earnings at Lockheed Martin than BE Aerospace? Yes. Why? What drives the price to earnings ratio? Think back to the key value drivers. 3 things. What are the 3 factors of the key value driver formula that affect multiples? All right, call the 4th thing tax. So, well, specifically, go back to key value drivers. Here's PE. What affects the multiple? It's not the level of income, it's these other 3 things. Right? And specifically, if we go to key value drivers, it's this formula. It's not the no-plat. All right, so tax can be an influence, but assuming that we look at the after-tax number, it's these 3 things. What are these 3 things? Growth, return, WACC. All right, so what I'm doing is I'm saying, how much am I willing to pay for the G? So what's left? The WACC and the ROIC. So assuming that companies have similar risks, what the PEG ratio is really differentiating for similar risks, how much do I pay for the growth, is the ROIC. Right? So that's the point. Both price to book and PEG are your best indicators of a company's spread, of predicted spread of the company. Right? Price to book is more subject to accounting challenges because people write off the equity all the time. So that can distort. The PEG, less so. I'm not saying there aren't accounting vagaries in net income. There are. But what you're saying is, how much am I willing to pay for the growth in the net income? Why would I pay more for growth? Because it achieves more ROIC. Here's the other thing to remember. If we go back way earlier in the semester, I believe this was in lecture 1. I showed you this slide, and I know it was a long time ago, but I said, here were 2 companies. They had the same earnings over time, right? But they had different free cash flows. And we said, well, why was company B more valuable than company A? It's because they generated more free cash flow. Why do they generate more free cash flow? Because they had less investment. Why do they have less investment? Because they made higher ROIC. This is where I showed you that there was a link between ROIC and free cash flow. And what we said was, at the same level of growth, that's what this is basically saying, identical growth, the company with a higher ROIC is more valuable because you either put in the same amount of capital and then therefore you make more profits, or for the same amount of profits, you don't have to invest as much, and so those profits generate more free cash flow. But that was the point. For the same growth, higher ROIC gives you more value. That, in a nutshell, is the PEG ratio. Right? So when we talk about the 2 ratios that give you insight into spread, Price to book gives you insight into the potential spread, assuming it's not distorted. PEG ratio gives you insight into differences in ROIC / return on equity across the firms. Right? So again, what can we say about Lockheed Martin versus a BE Aerospace is that this is distorted, and I happen to know it's distorted, but even when you do multiples, when one number looks far different than the rest of the industry, you can say that something's got to cause that, right? But here's the thing, PEG is usually cleaner. So this is saying Lockheed Martin probably has a higher expected ROIC than BE. So that's actually why you can interpret that from the PEG ratio. Okay? So the point is, what we're really trying to do is tell a story. Because remember that these multiples are another way of saying prices are based on all of the inputs. Okay? When we do the DCF analysis, what we're basically doing with the DCF analysis is we're putting in the inputs and we're spitting out an output. What we do with multiple analysis is we're taking an output and we're trying to figure out what the inputs are. We're working backwards. Either way, we got to get to the same information. So that's the point. That's the approach you need to take when you do a multiple analysis. So it's not just about creating a range and creating an average and saying the company is going to be at the average in the range. What you can understand is, why do you get to this range? It's because of those inputs. So what are the potential inputs that explain this range? That's what we're trying to understand when we do the multiple analysis. By the way, that is your upcoming homework assignment. So let's start out with the numbers themselves. What are the outputs? And how do I create this template that exists? So in Bloomberg, the area that you're going to do this is in what's called the RV screen. All right? So I look up any security, and we've been doing Coke, so I'll go to KO US Equity. This is Coca-Cola today. And RV stands for relative valuation. And you remember this from your Bloomberg certification, but basically what the RV screen does is it allows you to compare one company against peers very quickly. Okay? So click on RV or type in RV once you get to a company. And then it'll bring you to the peer list. Now, here's the next point. Number one, region. Okay? You can choose which region you want to compare companies against. By default, it'll go to what's called the region, or sorry, the country of domicile. So Bloomberg will say, what company or what country is the company headquartered in? It'll say that's the region that it'll immediately compare it against. So for example, Coke is based in Atlanta, so as a U.S. company, it's going to look at U.S. peers. If I want to switch and look at global peers, I switch to global, and this is more of a global list. Okay. Next, for comp source. Again, by default, a company will have the Global Industry Classification Service comps, the GICS. So basically, these are the standardized indexes of companies. And I think we talked about this earlier in the semester, but basically what we're going to use are the Bloomberg comps or the Bloomberg peers, because this is a curated list. Okay? Because basically what Bloomberg does is they will look through the list and then they'll say, okay, take this company out, put this company in. So it's kind of a manually curated list. Now here's the other thing. Once I've done this, I can then come down here to the edit. And if I don't like the list, I can change it. So for example, if I want to get rid of Britvic, then once I hit edit, I uncheck Britvic, I hit save. You sure you want to get rid of them? Yes. So the next thing you know, Britvic is gone from the list, and you notice that the comp source is now changed to custom. Right? So basically, and that's why it says custom, because I'd previously done this with Coke, but the idea is that you can create your own custom comp source yourself if you want to curate the list as well. Okay? So part of what you're going to have to do in your homework assignment is you're going to have to create the custom list for the company that I give you. So what's going to happen is I'm going to give you one company and 5 peers. Right? So you're going to have to take the list and you're going to have to get rid of everybody else, so you're just looking at that 6-company peer group. Okay? So I'm going to do that for Coke. And I'm going to get rid of a bunch of the peers. That's right. Coca-Cola Enterprises is the bottler. Coca-Cola Corporation actually makes the syrup and owns the brand. So basically, they sell to the bottler. Matter of fact, if you go back to the Novelis presentation, Novelis sends the bottler the can, and then basically Coke sends the bottler the syrup, and then the bottler puts the syrup and the mix into the can, paints it with their name, and then sells it. Because a long time ago, Coke decided to split the business into two, and they said, we want to put the major, the secret formula, which I can't imagine in today's chemistry world people can't figure that out, but technically the secret formula of the brand, and we want to control the syrup, so we'll sell the bottlers the syrup, but the bottlers are basically the distributors. So Coca-Cola Enterprises is actually the bottler, just so you know. But back to this. So what I'm going to do is I'm going to edit out some of the peers. So we want Pepsi to be a peer, we want Dr. Pepper, we want Monster, and we'll leave their bottler in there. Coca-Cola Enterprises, so that's 1, 2, 3, 4, 5, and then let's use as a peer, we'll just use this company, the Mexican Fomento. So uncheck all these other smaller companies, just doing it arbitrarily so we have a list. And then I saved it. Let me get rid of Ito as well. Okay, so I now have 1, 2, 3, 4, 5, 6 peers. So as I said, in your homework assignment, I'm going to give you the peers. Next week, we'll talk a little bit more about peer selection and why we're choosing peers. Today, I'm just going to arbitrarily pick 6 of the biggest peers in the industry. Okay, so these are Coke and 5 of its biggest competitors based on market cap. All right. Now, with that in mind, what we're then going to do is we're going to come over here to the Custom tab. And in the Custom tab is where I can take just about any ratio in Bloomberg, put it in here, and then it will quickly calculate it for the peers. So there are 6 multiples. Bloomberg actually stores the 6 multiples. It's already created, or I can also create my custom formulas. I'm going to put it into the Custom tab. So here's the other thing. Per the book, what we care about is the second forward year. Okay, so basically what we care about is for Coke, not 2014, but we care about 2015, right? Because basically the book said that the second forward year, the data tends to get more normalized. So when we think about multiples, we care about forward multiples, right? Because we're talking about future cash flows, and the second forward year tends to be more normalized, so that's the number that we're going to use. So, what are our 6 multiples? Well, the first one, I'll start out with enterprise value to sales. Don't accidentally put it at the top of the screen, because if you put it at the top of the screen, it'll bring you to a different company or a different screen. So when you create the custom, in the middle of the screen, click on where it says Add Column. All right, so I'm going to go out of order, but I'm going to do the enterprise value ratios first. So the first enterprise value ratio we need is EV to sales. So I can literally start typing EV for enterprise value, space, TO, space, sales, and then it will start giving me a filtered list. I can either click on more matches or choose off the filtered list. Now down here, you can see that there's already a Bloomberg field which currently exists called, excuse me, EV to this year's sales, this year's estimated sales, EV to next year's estimated sales. So here's the thing, in Bloomberg parlance, EV to this year's sales is forward year 1, EV to next year's sales is forward year 2. So Bloomberg already knows that you care about forward 2, so they already have a formula to calculate enterprise value to next year's sales. So EV to next year's estimated sales. Click on that, hit enter or return, and it's now in your template. Okay, we're going to do the same thing with EBITDA. So I'm going to add a column, EV space TO space EBITDA. Okay. Now, here's the thing. Bloomberg gives you a couple ways to get to the EBITDA. Can't talk today. And one of them is something called EV to best, capital BE, EBITDA. Best stands for Bloomberg estimate, or basically coming from the analyst consensus part of the database. So if I were to go to EV to best EBITDA, then what I could do is I can create my own period of time to pull from the database. So for example, what I could do is I could come in here and I could say customize a period, and then I could either use like a relative 12 months or I could do years ago forward. This is today, and I could say I want forward year 2, year plus 2, and that gives me a forward EBITDA for 2 years from now. Okay, so this is how I can actually create my own custom period ratio if I use the best. However, Bloomberg already has, so go back to this, EV to EBITDA, and they have an EV to next year's estimated EBITDA. So instead of creating it, the custom period, I'm just going to use the pre-existing Bloomberg field for next year's EBITDA. So we see the difference between the two. So I can essentially create it by using the best EBITDA and then just putting it a forward year, 1 or 2 into the future, or I can use EV to next year's EBITDA. Okay, which by the way, in Bloomberg, because we're using the estimate, that would be year plus 1, right? So that would be, in this case, that would be the 2015 EBITDA, which is the next year, the second forward year. All right, so we now have EV to EBITDA. Next, we need EV to EBIT. So EV space to EBIT. So same thing, except here's the thing. Because EBIT and EBITDA gives me both responses, I can show more matches. And if I scroll down, it'll tell me everything that matches the search results. Now, I can also manually go to a particular part of the database, and by clicking on things, I can get to the ratios. But basically here, if I look EV to EBIT, what I'm really looking for is EV to next year's estimated EBIT. And by the way, if you go over to the right, anytime you click on the search and search for a field, it'll give you the actual formula in Bloomberg over here on the right. So I'll select EV to next year's estimated EBIT. Right? So I now have the 3 enterprise value ratios. Next, I want next year's price to earnings ratio. So basically, I do price to earnings. You can also just do P to E. And again, I can either use the best PE and calculate it or show more matches. The search results are always, for some reason, down here at the bottom. So what I want is the best PE, the Bloomberg estimated PE for next year. Sorry. Yeah, PE for next year. Okay. Next, I want the PEG ratio. Okay, so I got the 3 enterprise values. I got the PE. Now I want the PEG. I can literally type in PEG. All right, and same thing. There's a Bloomberg estimated PEG ratio. Now in this case, I'm going to want to use the current year's PEG, which is basically the current PE divided by the estimated growth rate. Right? And because you'll notice that that's for 2014. Right? Actually, take it back. I don't want to use that one. Let me delete this. I want next year's PEG. We want 2 years out. So let me go back to the PEG. So I want the best PEG next year. That would be the 2015 PEG, based on the 2015 estimate for earnings per share. So 2015 PE divided by 2015 earnings per share. That's the next year's PEG, as opposed to the current year PEG. Just to be consistent with everything else. right? So I have 5 of the 6 ratios. The last ratio is price to book. So I literally type in price to book, and I get to the price to book ratio. Now, price to book is different than the others because I can't really have Bloomberg estimate for me a stock price next year. So it's the current stock price divided by the book value of the equity today. So in that case, I'll use the current price to book. Okay? So current stock price times shares outstanding, market cap, divided by current book value of equity, price to book. Okay? All right, those are the 6 ratios. That's the template. Now, here's the other ratio that we're going to add to our template, which is the long-term growth rate, LTG. All right? So specifically, it's just what you see here, the best estimate long-term growth rate. Okay? Now, long-term growth rate in the financial community is 5-year growth in earnings per share. That's generally what people define as the long-term growth rate. It is not the same as the G in our models, because the G in our models is the growth in free cash flow into perpetuity. The long-term growth rate, the LTG, that the model uses in Bloomberg is the 5-year growth in earnings per share. So here's the thing. They're not the same number. However, so in this case, I'll use the best estimated long-term growth rate. Oh, sorry. And I'll do it from 1 day ago, so I'll use the most current one. So here's the thing. For Coke, it's 5.76%, right, as of yesterday. All right? So that's what the database has for what the analysts think Coke's long-term growth rate in earnings is going to be, which is another way of saying 5% a year for the next 5 years. Now here's the thing. That doesn't equate to the G, but what we're going to do is we're going to use it as a sort of a directional proxy for the G. All right? So the LTG is not the same as the G, but we're at least going to look at the magnitude of that G versus the other company's Gs to get a sense of who the market thinks is going to grow faster or slower. So for example, Monster's long-term growth rate in earnings is 22%. Coke's long-term growth rate of earnings is 5.76%. Monster's growing at a rate of 4 times as fast as Coke in its earnings. So that's the point. My G for Monster is not going to be 21%, because if you think back to the key value drivers formula, just as a quick example, I can't actually have a G greater than my WACC. All right? So G will always be less than your WACC. And WACC for Coke, we already know, is around 7%. So the highest long-term growth rate I could even have for a company with a WACC of 7 to 10% is not going to be more than 10%. So I can't use a 20% G. So that's the point. The LTG is not necessarily telling me that that's the number I use in my key value drivers formula. But what it is telling me is that Monster is expecting a whole lot more growth than Coke is. And that would make sense because Monster is still a relatively young, smaller company, and they have a lot of growth ahead of them, where Coke is a much more mature company, and they're struggling with the basically sugar problem that they're having in the market today. So again, magnitude-wise, Monster's earnings are going to grow faster is really what I care about. How I apply it to the model will be different, but at least it sets up a general directionality that I know that Monster is expected to grow much faster than Coke is. That's the real key here that we're going to infer into our model. Does that make sense to everybody? All right, so we now have these 6 multiples plus the long-term growth rate. So our final step is to save this as a template. So this is where you click on Save As, and then you can call it whatever you want. So what I'll call this is 443 multiple template. You can have up to, I think, 11 characters in the field name. Hit Save, and then what it's going to do is it's going to add a sub-tab right here next to Create Template. Right? So again, no matter what company you go to, if you now go to the RV custom screen. So let me change this to Pepsi. Hit enter. Then notice if I go to the custom tab for Pepsi and go to multiples, then here are Pepsi's peers. Right? And then the template is already loaded. Right? So that's the advantage of doing it this way. So you create the template once, reuse again and again and again. So in our case, let's go back to Coke. For my simple example, let's go back to my custom peer list. And then here's the last and probably most important part. Select stats, market cap weighted average. So this will give me a average of the multiple based on the market cap. So here's the point. The small company, Monster, has a great multiple, for example, compared to the others, but by using the market cap weighted average, it's not going to distort the entire multiples for the industry because it's kind of weighted based on size of the company. That's why we're using the market cap weighted average as opposed to a straight average, okay, to eliminate a little bit of the distortions of the smaller companies. Yes?
Where'd you go to get the market?
So once you, in any of the screens, down here at the bottom, select stats. Now you can also, and I'll just put it on here, I can click average. And you can see the difference. That, for example, if I use the average, I get slightly different numbers, for example, for long-term growth of 11% versus a market cap weighted average of 8%. Right? So I'm just saying for purposes of our analysis, we probably want to lead more towards the market cap weighted average at the industry level because we don't want to think that the industry is growing faster than it really is because some of the small growth firms are going to make it look like this industry is growing faster than it actually is. So using the market cap weighted average gives us a more representative view of what the industry level of growth is. And to me, a better way of looking at the multiples. Right? You can get both out of Bloomberg, right? But nonetheless, market cap is the one we're going to use. I'm going to unselect the average. There's other, if you want to put median, mean, average, standard deviation, some other statistical function you can apply. All right, last step you're going to need, you're going to probably want to dump this to Excel. So output Excel. Remember, you're going to get a security warning. So just as in the FA screen, where you got a security warning, you're going to get a security warning here. Okay. Now, these numbers are actually not numbers. If you remember in the FA section, we had to go into the settings and tell Bloomberg to export numbers. Where here, we're actually exporting the database lookups. So let's go back to settings. And let's go to display, export, I forgot to do this, static data. Update. Probably want to do that. So now I'm going to re-export it. Output Excel. So now I actually get these as numbers. Right? Doesn't mean you couldn't take the last export that we did. Just remember, if you didn't do this step, it's very important that you copy paste special values so that you can leave the lab with the Excel file. So if you didn't export the numbers, you just export the database lookups, you'll need to convert them into numbers before you leave the lab. Otherwise, what will happen is the next time you open the Excel file, it's going to look for Bloomberg. And if you're not logged into a Bloomberg terminal locally, it's just going to give you a bunch of errors. Right? So that's why you probably want to switch it to this format. Plus, it gives you a nice, prettier version of the export. Right? So here's my data. So I'm going to save this. So I'm just going to call this KO peers. All right. Now, these are the multiples. And here's what I'm going to want to do. So these are my multiples. I'm going to do this in, save this. And let me jump over here back to my Mac. And I'm going to open this up in my Mac. So I've left the lab, I'm in my local machine, and I'm in Excel. There's the data that I just exported. So here's what I want to do. This is my data. Now, if I go back to key value drivers, this is the formula for enterprise value to EBIT. This is the formula for enterprise value to sales. Okay, so first, here's what I want to do. So I'm going to go back here and I'm going to say estimated EBIT margin. For these companies. So basically, how do I get my estimated EBIT margin? Well, if enterprise value to sales is the margin times enterprise value to EBIT, then I take my enterprise value to sales and I divide it by my enterprise value to EBIT. So here's the point. Equals enterprise value to sales divided by enterprise value to EBIT. And I could do this as a percentage. But basically, this, looking at that data, is the estimated margins that make that data work. This is the EBIT margin, pre-tax operating profit, divided by sales. Right? So if I go back to my model for Coca-Cola, that we have been using, here was the as-is model that I was working on. In our as-is model for Coke, on the ratio screen, we were forecasting EBITDA, but this is giving me this number. Right? Now, how do I get to EBITDA? I add in the DA. Right? But this is the point. Now, this isn't the every single year has to be this number. What this really represents is an average EBIT margin over time, proxy EBITDA margin over time. Okay? So I don't necessarily be in this number every single period, but longer term, this is the number I'm probably going to average out to. So here's the point. Right now, based on the analyst estimates for 2015 that we pulled 2 weeks ago when we started working on Coke, the analysts predicted this EBITDA, and given the same depreciation rate, effectively an EBIT margin of 24.4%. That's the next 2 years. But if you look at the multiples that Coke is trading at today, now, again, timing matters based on this formula, but what has now happened is that because of the poor results that Coke did, that number is 23.7 long term versus 24.7. So in a way, what you can see as the stock price started trading down, people are starting to expect slightly worse margins for Coke than they're getting, and even predicting with the estimates for the next 2 years longer term. So when I start trending down my model, then I have, and eventually we got down to 22%. All right? But even with the pessimistic view of the stock today versus 2 weeks ago, the market's still not expecting 22% as the long-term EBITDA. So this is an important insight because one of the things we had to do when we did the as-is valuation, as I said, there were 3 things that were going to drive your as-is valuation. Right? One was the tax rate. We had to come up with a representative tax rate. The second was the margin. And here's the point. This gives us a starting point for the margin. And a much better starting point because it's market-based. Not saying we have to agree with this in our valuation model, but if I really want to understand the wisdom of the market, I can back this in. And then the third one was the revenue growth. So here's the point. What we were struggling with was, is it lower revenue or lower margin that was causing Coke to have the stock price where it was today? And my initial argument was it might have been lower margin and lower revenue. But to be honest with you, if you actually look at the way we did our model, I think that what the market is saying is what? Here's our model. Here's our model. Here is the insight. From the multiple. So where did I miss in our model? Assuming the market's right. What should I have done? Now that I've seen this data, what should I do differently? Yeah.
How did you get that value?
Which value?
The EBIT margin.
This one?
Yeah.
Enterprise value to sales divided by enterprise value to EBIT. That is this formula rearranged. So basically, cross this out, divide value to E, B, I, T. It's kind of hard to draw with your mouse. But basically, that's all we just did. We just rearranged that formula. Right? So here's the point. What I did is I kind of estimated what the market thinks, but that's what I said. What I now realize as I go back to my valuation model is these numbers are probably too low versus where the market is. This is for as is. So what I probably want to do is I probably want to raise these a little bit, which means I'm going to lower these. So as I said, when we were first just doing the dumb plug-and-play exercise, we're like, oh, well, let's change the revenue, see what happens. Let's change the margin, see what happens. And we're just doing a mathematical exercise to equal the stock price. We were kind of doing a range, but this gives us a better sense of how to do that range. Because now I have a clearer picture of the margin. And so therefore, I know that it's really the revenue that the market expects to be lower than what I was putting into my model, and the margin a little bit higher. So it helps with my as-is valuation. And this is what I mean by triangulation. Right? So what we're doing is we're taking our assumptions and we're triangulating it with both the multiples and with our DCF. Because the value of the company can't change if we use a multiples approach or if we use a DCF-based approach. Right? So since we know that those have to sync up, the DCF is putting in the inputs to get the output, the multiples are the output, and they're based on the input, they have to sync. So that's the point. I'm using the market-based data to see what kind of assumptions the market had to use to get to that output. Now this again is not whether I agree with this. Right? That's where we get to the final and second valuation. I could say I don't agree with what the market has, and therefore I can change that, see what the price is, and that creates the buy, sell, hold opportunity. Right? But I'm telling you, this is where somebody like Warren Buffett has made a lot of money long term, because he has a fundamental understanding of the business model, right? The intrinsic value, which is basically the DCF and the drivers of the DCF. And then he is just constantly looking at the pricing data that the stock prices are at and then the multiples that they show. And when he sees the discontinuity, when he sees the bargain, where the multiples are trying at a lower value, and he realizes that the market has the wrong growth or the wrong margin assumption fundamentally for a company he's got a very strong point of view on, that's when he buys them and puts them in his portfolio. That's the long-term buying opportunity, right? But he's not just looking at it in the short term. He's got to believe that long-term the market's got it wrong, right? And so, not saying that he's right, but he tends to be a little bit more right than wrong because that's where the EIC analysis comes in. So that's why I gave you the example about what Novellus showed us here today. So Novellus is all about aluminum. And you can say, well, aluminum is a commodity. What makes them different than iron ore, which is any other commodity which is used to make steel? And part of what the presentation today was about is that basically what's primarily different is going to be that the automobile manufacturers are about to have a huge amount of demand, which is going to cause a little bit of a supply-demand imbalance, which is probably going to mean a little bit better pricing, right? It's not going to be completely high pricing because at some point they'll go back to steel if it gets ridiculously expensive, but a little bit better pricing, and that's a little bit higher value add. Plus, that's the other point. Aluminum value add is they're not just selling the, I forgot what he called them, but the pellets of aluminum, what are they called? Basically, the way you actually sell the aluminum is he said you take about half of this room, there's just this big block, right? And you basically just sell that. It's just a big slab. But here's the thing. What Novellus does is they actually roll it so that it goes very thin, and then it goes to the manufacturer, and they can stamp it and mold it and fix it. Well, that's a little bit more value add to the process than somebody just sells you a big slab of steel or a big slab of aluminum. So by doing that extra value add, they're able to get a little bit more pricing. And because they have the capability to do the value add, then it becomes a little bit less of a commodity. And then you're tied into the supply chain of the automobile manufacturers. That gives you a little bit longer term competitive advantage, because going from a block of aluminum to a block of aluminum, there's no difference between the aluminum of Alcoa and the aluminum of Novellus. But once it's rolled, once it's built in their supply chain, once they're used to getting your aluminum in this particular process, and once you have a longer term contract with an automobile manufacturer, now you start talking about not becoming a commodity anymore, and therefore potentially higher prices. The reason why this all matters is because what we're going to do is we're going to forecast EBITDA, and we can see even for a company like Novellus, their EBITDA margin went from 4% to 9% over the last 3 years, as they've already started to see growth in the recycled can, and they've already seen growth in the automobile industry. You give me 4 times the volume in the next few years, they're not going to get 100% of that, but it does say that maybe as an aluminum manufacturer, their EBITDA margin may not fall to 4% again, and it actually might go higher even in a cyclical business, right? And that, by the way, is the fundamental question that's being asked of that company by the analysts right now. And there are a lot of companies that are going to be very interested in potentially investing in this. So that's how you start to think about the investment opportunity. So this is how we're starting to tie the type of analysis we've done together. But as a point, what I really want you to do is I want you to start explaining the differences in these multiples. And one of the factors that's going to explain the difference in the multiples, starting with enterprise value to sales, is to understand the differences in the margin. So that's the point. Why is, and I'll go back to Coke here, why is Coke trading at a premium of enterprise value to sales to, and I'll use Dr. Pepper Snapple as an example. Why is this 4.23 and this 2.49? Why is Coke trading at a premium in enterprise value to sales? Yes.
For every sales they have a higher margin.
That's right.
So they get more value.
This is exactly. Now, it's basically just saying the exact opposite of what we just solved for. Is that very clearly you can see that I'm paying a premium for Coke sales because they're getting better margin on their sales. So that's the point. They have a higher margin, therefore it's higher enterprise value to sales. So why is this Mexican company getting the lowest? And it's because they're the low margin business. Same thing. Think about, why does Coke not want to be in the bottling business? What would be the argument against being in the bottling business? Yeah,
Low margin.
exactly. It's a lower margin business. And you can clearly see that in the differences in enterprise and sales. So that's the point. If the bottlers grow, they're not going to add as much value as if Coke grows because they don't have all of that lower margin, tougher business. But here's the other part. What's going to matter is the ROIC, the expected ROIC of these businesses, and what is the growth rate. So here's the point. I can see the margin. Then I need to know to some degree the productivity, which infers the expected ROIC. So how do I figure out the expected ROIC of Coca-Cola? Well, in this case, this is where you have to do the modeling work. Let's go back to our model. Well, what do we have historically for Coke? We have the operating ROIC, which matters the most. Well, just to put this in a nice little table, here on the ROIC drivers is the operating ROIC for Coke for the last 5 years. Right? What's the operating ROIC of Coke on a go-forward basis? Right? Well, to some degree, when we put in the margin and the sales growth, we'll start to get a little bit of an idea, but I can tell you that if I go back to my, in this case, it'll be on the EOY ROIC, then the ROIC that I'm expecting in the model for Coke for the next 2 years, based on the earnings estimates, is around 29.5% and 30%. 29.5%, 30.6%. So here's the point. Basically, if I look at the next 2 years, which is basically what this forward 2-year data is based on, then in my model, I basically have, we'll just call it 29.5, 30.6. I'll take the middle. I'll say approximately a 30% ROIC. Everybody with me on that? What I did is I went to our valuation model and I looked at, based on the earnings estimates we put in, 2014, 2015, end of year ROIC, next 2 years, I just took the average of the two. I eyeballed it. Right? I used my judgment. Right? So here's the final step, and I know we're running out of time. So what is the formula for enterprise value to EBIT? It's right here. Okay? So here's the point. If I go back to my model, enterprise value to EBIT, what do I need? I need to do that. I need the tax rate. I need the long-term growth. I need the ROIC. And I need the WACC. Those are the things that I need. Well, here's the thing. The tax rate I already have in my model. We had estimated a tax rate for Coke. Where is it? On the ratio screen, that we said was going to be 22.3%. I'm having trouble with too many things going on. 22.3%. G, I'm going to want to solve for. So that's the point. I want to solve for the long-term growth, my G. All right? So this is what I'm going to solve for. My ROIC is 30%. That was that number. My WACC, when we did the Coke valuation, was, we said it was 6.9%. And my current enterprise value to EBIT is 17.82. my forecast is the result. So here's the point. What's the formula? Well, the formula is equals 1 minus the tax rate times 1 minus the growth divided by the ROIC. Take all of that, divide that by the WACC minus the G. And that number needs to be 17.82 or close to it. So here's the point, 3%. I'm really close. In fact, I'll go to a couple decimal places. 2.9, 2.95. I'll be close to 3. Call it 3. That's what I'm solving for. There's my long-term growth rate for Coke. So I now have a guess of the long-term growth rate, a guess of the EBIT margin. Now this is the long-term growth rate. I'm going to use the continuing value. How I get there, I can actually modify the individual years. What I'm saying is I'm backing into a market-based approach. So when I said that I thought Coke was going to grow about the rate of the economy, as I told you, I cheated. Because I already knew that the long-term growth rate that equaled the current valuation was right around 3%. Right? Because I kind of knew that based on the multiple that they were trading at. Right? When I came up with what I thought the long-term margin was going to be, I kind of knew that they'd be in the low 20s because that's what the multiples told me. So it's not whether I want to agree with it, but at least I can back in when I start doing my as-is valuation to help me do my assumptions. So this is going to be your homework assignment. For all 6 companies that I give you, you are going to have to do this analysis. You're going to have to estimate their margin. All 6 companies, you're going to need their ROIC. All 6 companies, you're going to need their G. You're going to do an as-is valuation on one of the 6 companies, but you'll need to do the other 5, and here's why, because then you're going to try and explain the multiples. So the other part of this analysis is why is Coke trading at a premium or discount, which means higher or lower than the average of its peers, and it's these factors that explain why it's trading at a premium or discount. So for every one of the 6 companies in your homework assignment, you have to give a slight write-up, think about it, called a paragraph, so 6 paragraphs, that basically explain why that company is trading at a premium or discount. Right? Now here's the reason why you have to do, and I wouldn't say a complete as-is valuation, but the part that you're going to need to do, and this is the extra work, is for all 5 of the other peers, you're going to have to put the data into our model and put in the earnings estimates for the next 2 years because you got to figure out what the expected ROIC is of that company for the next 2 years. That's why you're going to have to do 6 sets of data pulled from Bloomberg. Now, one of them you're going to use to do the as-is for that company. So that's the point. Your assignment for Monday is an as-is of a different company in a different industry. Right? And then on top of that, and by the way, here's your heads up, it's going to be Walmart. Okay? So it's going to be retail, and it's going to be Walmart, and 5 of its biggest peers. Right? So for those of you wanting to get a head start on that. Right? And then basically, you're going to take the other 5 peers, Target, Costco, etc., and what you're then going to do is you're going to basically do a valuation as-is of Walmart, backing in some of the initial assumptions to help you with the as-is, and then you're going to do the multiple analysis and explain the difference in the multiples for all those peers. That's your assignment for Monday. It's a little bit of a bigger assignment. That's why it's worth 4 points, but it's a straightforward assignment. Does that make sense? This, by the way, is what you're going to have to do for your group project multiples as well. Questions by that? Great. We'll see everybody on Monday, 10 a.m.